a PGTBM in finance, and it brings 12 years of rich experience in the financial industry. Starting her journey at Philip Capital Private Limited, she honed her skills as a research associate and then as a research analyst from 2009 to 2013. She further excelled at Tata Asset Management Limited, where she made significant contribution as a research analyst for 2014 to 2018 before being promoted to assistant fund manager, a role she held until September 2021. Currently, Annette is a fund manager equities where she continues to demonstrate her expertise and dedication to driving investment success. Please join me in welcoming Miss Annette Fernandez. So over to you, Annette. Thank you so much.
Thank you, Disha. Thank you so much for setting the context for today's discussion. And today, Canara Robeco Mutual Fund comes before you with our NFO for Canara Robeco Balance Advantage Fund. I know, considering the context of the market, we see, most of the NFOs at this time being more towards, say, thematics or, multi-cap, small cap, mid-cap, etc. We see flows also in the domestic mutual fund industry, obviously in, these particular categories at this point in time. However, we thought that it would be the right time to actually shift the conversation for investors from not only returns, but towards risk adjusted returns. Risk adjusted returns is also the investment philosophy for Canara Robeco as a fund house, because we have always believed that an investor's journey, especially in equity markets, is not only about returns but also about managing risk and managing the returns at the same point in time. In the last, obviously, 2 years, considering the way that the markets have been, all the conversation, has been shifted completely towards returns. And we feel that it's a time that, we steer that conversation again from only being on returns towards risk adjusted returns. It's a good time to look at, diversifying the, portfolio of investors from, what we see currently right now towards, small, mid, and thematic towards obviously products which are more balanced, like balance advantage fund, aggressive hybrids, etc., or other diversified strategies like flexi cap, multi cap at this point in time. Hence our NFO of CRBAF. We have a brief presentation that I would want to put across to you and take you through to give you an understanding as to what we perceive is an investor's journey in the equity markets. What are the various kind of challenges that they face, how BAF as a product is actually one of the solution to that challenge, and ultimately I would want to talk about CR BAF with all of you all. So coming to obviously investors with respect to equity markets, they always think that returns will be linear and it will always be upward moving, just like what we are seeing at this point in time. But we all know that, equity markets are extremely volatile in nature. This volatility is there at different points in time. The most important aspect is that events that cause this volatility tend to be different at different points in time. Like, for example, we never had COVID, right, earlier, or we have not undergone demonetization earlier, or we didn't face GST, or we didn't have the great financial crisis which had Lehman's Brothers bankruptcy happening at that point in time. So as you can see, there are different events at different points in time. But what happens is, because of this volatility in the markets, investors obviously being more subjective in nature, we see that their behavioral bias tends to come out at different points in time. But more importantly, especially at the peak of the market and at the bottom of the market, we tend to see that investors tend to take the wrong decisions in terms of their investments. We always say that investors should buy low and sell high, but we always see that it tends tends to be the reverse at different points in time, where they actually buy high or they sell low. And that's what we wanted to showcase to you over here, that at the peak of the market, when it's the time when investors should be taking some money off, we see that flows continue to be very strong. Similarly, at the bottom of the market, when it's the time that you should be doubling down in terms of your investments, we see that actually investors being more anxious tend to withdraw from the market. It's because of this emotional based investment decisions, this behavioral gap, because of which we see that investor returns tend to lag investment returns at different point in time. When we were studying this, we actually came across a very interesting study undertaken by an organization called Albert in the US. In that, they conducted the study during 2004 and 14, and they took the returns for S&P 500 during the duration of around 10 years, which came to around say 8% CAGR. They took a sample of folios and calculated the returns from the investor's perspective, and the returns over there were lower than 5% CAGR. So as you can see, a difference of almost more than 300 basis point in terms of returns for the investor vis-a-vis the S&P 500 index. Then they further tried to quantify that what were the reasons for this underperformance. And as you can see, a majority of the reason for that underperformance, more than 45% of it, is on account of voluntary investor behavior, which is the same thing that we spoke earlier, the behavioral gap, where investors tend to be subjective in nature. Emotionally, they tend to take the wrong investment decisions at different points in time in the market. They try to time the market, and hence we see that this voluntary investor behavior leads to suboptimal returns for them. Again, from the context of the Indian market, we try to see, how this behavior has been. And as you can see, at different points in time when market is at its peak, we have seen that flows into the domestic mutual fund industry actually increased during those particular time periods. Similarly, we also did this exercise vis-a-vis the valuations for the index. And again, you can see that at different points in time when the markets were at their peak, we saw that flows into the domestic mutual fund industry also increased at that point in time. While it should obviously have been reversed, that when the markets are expensive, you should be taking some money off. But obviously, we saw that money just kept coming in. We tried to drill this down further. And just to give you an example, we took this period of October 18 to 20 when the markets were almost at a 30% premium to its historical average. Surprisingly, in spite of obviously the premium, we saw that the kind of flows that came into the domestic mutual fund industry was almost to the extent of 2.5 lakh crore. But the funny part is that during that duration, the returns for the investor were only at around 3% CAGR. So again, similarly, just trying to show an example where many a times at the most crucial junctures, we tend to see investors taking the wrong investment allocation decisions. So as you can see, we have laid down different challenges that an investor faces. Obviously, because of volatility in the markets, the risk that is associated with equity investing, they tend to be subjective in terms of how they should be allocating their money. Because of that subjectivity, because of their need to try to time the market, their investor returns tend to be lower than the investment returns. So, is there any product which in some way addresses these challenges from an investor's perspective? And the answer is yes, and that product is a balance advantage fund. Why Balance Advantage Fund? Balance Advantage Fund, as a product, you all know, is more model driven. So, thereby, it is more objective in nature. Unlike an investor who tends to be subjective, as you can see, because BAF is model driven, it is more objective in nature. The rebalancing in the portfolio, is dynamic and happens periodically, because of which, again, you take out the timing of the market that, investors try to do at different different points in time. Similarly, and lastly, and more importantly, BAF as a product not only ensures that you participate in the upside, that there is returns from for the investors, but also it protects your downside. So it manages the risk part of it. Hence, BAF as a product tends to give you better risk adjusted return. It balances risk and return both very optimally. And secondly, it also ensures upside participation and manages your downside risk. Showing the risk adjusted return part, here we have showcased to you the return and the risk profile for both the asset classes of equity and debt. And as you see that when you keep changing the mix between equity and debt, obviously as the equity proportion reduces, the return profile of the portfolio comes off, but more importantly, the risk profile also comes off. So what BAF does is that balance advantage fund sees to it that the asset allocation between equity and debt keeps changing depending on the market cycle, thereby ensuring that for an investor, not only is their risk managed very well depending on different cycles in the market, but also sees to it that on the return side also you get optimum returns at different points in time. Similarly, when it comes to upside and downside capture, what we wanted to show to you was very simply the returns for equity, debt, and for the BAF category, the average return for the BAF category. You can clearly see for yourself that while equity and debt tend to be either at the top or at the bottom at different points in time, BAF as a category is the only one which at most of the time is consistent and lying in between, thereby ensuring that there is sustainable returns that an investor can get at different points in time and over a long-term horizon. That's why we say that BAF is actually best of both the worlds. It manages your risk very well, and it sees to it that you participate also on the upside. So the risk and the reward actually works very well with a BAF product. So just to come to the other features with respect to BAF, as you can see, we discussed earlier, it eliminates the behavioral gap that an investor has. It's more objective in nature because it is model based. There is dynamic rebalancing that happens of the portfolio at different points in time. Apart from obviously asset allocation, both the equity and debt are actively managed by fund managers, and that's why there is an additional alpha that you get depending on the investment strategies that are there in equity and debt carried out by the respective fund managers. Lastly, in BAF, at every point in time, we tend to have a gross equity exposure of around 65%, on account of which obviously investors will get the necessary tax benefits. Now, we have seen, investor challenges. We have seen how BAF as a product is a solution to that challenge. So, I want to introduce to you Canara Robeco Balance Advantage Fund, CR-BAF. CR-BAF is a three-factor model comprising of the 12-month forward price to earnings ratio, trailing price to book ratio, and the equity risk premium. So before we, started working on this model, which has taken us, more than a year, we wanted to set a clear objective that the model has to achieve. From an investor's perspective, we realized that for BAF as a category, the investors' expectations have changed in the last 5 to 6 years. So 6 years ago, an investor in BAF was obviously conservative in terms of their risk. So, risk profile used to be on the lower side. Whereas on returns, they were happy with fixed deposit plus 250 to 300 basis point. However, we have seen that in the last 6 years, that is not the case anymore when it comes to returns. In terms of risk, it is still the same. They are conservative in nature, so they do want their downside to be protected. But when it comes to return, the expectations are obviously far higher. They do want an absolute double digit return and not something which is little better than fixed deposit. So keeping this in mind that downside needs to be protected, but also on the upside we participate well, we set the objective that the model has to not only manage the downside well, but also has to have an optimum upside participation. So that was the objective that we kept for our model. Initially, when we started working with the model, we had many other factors apart from the three that are there on the screen. But as we were doing various iterations, we decided that, let us try to see to it that we get the same outcomes that we want from the model, but keep the model simple. And we saw that we were able to achieve that. We were able to achieve the results that we wanted with just these three factors. So, hence, forward price to earning, trailing price to book, and equity risk premium became the three factors in our model. Now, what is the reason why we chose these three factors? What we wanted the factors in the model to do is help us address two things. One is the market cycle momentum. The second is the fundamental aspects of the business. When it comes to market cycle momentum, we saw that price to earnings ratio very well captures the near term market momentum, whereas price to book ratio captures the medium to long term momentum that is there in the market. So, hence, price to earnings and price to book in their combination helps us to address the market cycle momentum. On the other hand, the second aspect, which is the fundamental aspect of the business, we drilled it down to two factors, that is growth and quality. Growth and quality is also a core part of the investment philosophy at Canara Robeco Mutual Fund. So for growth, in our view, price to earnings captures the earnings growth momentum very well. So whenever you see any change in earnings for companies during, probably, the quarterly results, etc., we see that it immediately gets captured in the stock price and it gets immediately captured in the multiple for the company, in the valuations for the company. Similarly, on the other hand, when it comes to the quality of the business, quality of the management, there is nothing better than the balance sheet to obviously understand that. How strong is the balance sheet, what have been the capital allocation decisions over a period of time, the financial leverage, deleverage, and we saw that the price to book ratio captures these aspects of the balance sheet very well. So, hence, with price to earnings and price to book, we were able to address both the market cycle momentum and also the fundamental equity risk team. Risk premium is nothing but obviously the difference between your earnings yield and the GSEC yield. And it helps us in terms of, it helps the model to understand how the allocation should move towards equity and debt. So equity risk premium actually supports price to earning and supports the price to book at different points in time in trying to decide how the allocation should be moving towards equity and debt. This is to showcase to you how the equity allocation for the model has moved over the last 20 years. As you can see, on an average, we have had 67% equity allocation. These slides just show that how the equity allocation has obviously an inverse relation to the three factors that are there in the model, meaning that obviously, if the price to book ratio increases or the price to earning ratio increases, it means that the markets are getting expensive. Uh, so when they increase, the model should be giving an outcome that you need to reduce your equity allocation. So as you can see, there's an inverse relation between the equity allocation and the factors. So you can see in the slide here also that the equity allocation is a complete mirror image of how the factor moves. So be it price to book, be it price to earnings, or be it the equity risk premium, there's an inverse correlation for all three of them for the equity allocation. Now, these are some of the backtest results that we will start showcasing to you. This is the result where we, measure the performance of our portfolio vis-a-vis that of the benchmark. The benchmark over here is CRISIL Hybrid 50/50 Moderate Index, and you can clearly see over here that whether it be a longer duration, medium duration, or shorter duration, the model has done better than the benchmark. Test results where I want to draw your attention more to because this will help you understand the downside capture that the model has been able to deliver at different points in time and different market cycles. And we have done all the back testing for upside and downside with respect to BSE 200. So over here, you can see that on an average, the upside capture has been almost around 80%. Why I want to highlight the number 80% is because when we were doing the iterations, we kind of concluded that an 80% upside capture at different points in time was giving us the necessary outcome that we wanted in terms of return. Similarly, on the downside, we noticed that limiting it to 60% downside capture was again giving us the necessary outcomes that we wanted the model to achieve. So, with a combination of 80% on the upside and 60% on the downside, the model has been able to do better than the benchmark over a period of time, and obviously better than the category average returns over a period of time. So this is obviously, as you can see, that apart from the upside capture of around 80%, whenever the index returns are negative, flat, or single digit, you can see that the model has done better than the index at those period of time. This is another backtest result where we calculated the returns for the model and also the standard deviation from March 2005. The returns for the model is around 13% CAGR, while that for BSE 200 is 15% CAGR. So as you can see, again, 87% upside capture. On the other hand, when it came to risk, where we have taken standard deviation as a parameter over here, that was limited to 67%. So again, a ratio of around 1.3 between upside and downside. As you can see, 87% here on the upside and 67% in terms of risk. Coming to another backtest result, what we did over here is that for both 10-year and 20-year period, we divided the returns of BSE 200 monthly returns on 1 year basis into two buckets. One bucket is positive return, the other bucket is negative return. So in the first bucket of positive return, for every month that BSE 200 returns were positive, we calculated the returns for our CR-BAF model also, and we saw that 80% upside capture or 80% upside participation is what the model was able to deliver both in a 10-year period as well as a 20-year period. Similarly, in the second bucket, where BSE 200 returns were negative, BSE 200 monthly returns were negative, we calculated the returns for our model also during those months, and we saw that on the downside, it was limited to around 60%. So again, 80% upside, 60% downside. So it's simply like if the market returns are plus 10, the model's return is somewhere around plus 8. If the market returns are minus 10, the model returns are somewhere around minus 6. So 80% upside, 60% downside. This is just to showcase to you how the model works. So as you can see, the first two rows, April '06 and July '06, the factors for PE and price to book obviously reduced, which means the market has become attractive. The valuation has come down. So since the markets have become attractive, the model obviously suggested to increase the allocation. So from 48%, the allocation was increased to 71%. Then what we did is that we calculated the returns for the index and for the model 1 year from that period. So as you can see, the BSE 200 returns were 50%, while that for the model was 36%, so 70% upside captured. Similarly, the next row you can see for December '07, the markets became expensive because the valuations moved up. So if the market valuations have moved up, the model obviously suggested to decrease the allocation. Then again, we calculated the returns for the index and for the model 1 year from that period. So while the BSE 200 returns were minus 56, that for the model was minus 37.5. So downside limited to 67%. So as you can see, on an average, even in this particular slide, we have been able to capture 80% of the upside and limit the downside to somewhere at around 60%. Last in our backtest, what we did is that we wanted to showcase how the model has done during phases of volatility. because we believe that during these phases is where a BAF model largely stands out. It does best in managing return and risk during these phases of volatility. So we chose volatility phase, which is of a longer duration, and we also chose volatility phases, which are for a shorter duration. So this is a longer duration phase of volatility, and nothing better than GFC crisis to actually show it. So as you can see, between December '07 to September 10, while the market returns were only around -2, which is over a period of almost nearing 3 years, you can see that the model's return was almost 16% during that period of time. So again, showing that how the equity allocation moved very well depending on the market cycle and was able to deliver better returns than what the market was able to do point to point. Similarly, we just extended this period further to 2014, and we again saw that while the model returns were somewhere at around 28%, the index returns were lower at 24. So the model was able to do better than the index even during this time phase. Uh, we took this period of volatility, which was a shorter duration, like I mentioned earlier. So 015 to 016 and 21 to 22. As you can see over here again, the index returns are 4.5, model returns are 10%. During 21 and 22, index returns are flat, model returns are 3.3%. So again, showcasing to you that it's not just on an annualized basis or calendar year basis that the model is doing well in terms of upside capture and downside capture, but during phases of volatility is where it stands out in terms of doing better than the market. Lastly, in our back testing, we just bucketed or categorized the returns of BSE 200 into four. The category of negative returns, category of 0 to 8, category of 8 to 15, and 15% plus. As you can see in the category of negative returns, the model has definitely done better than BSE 200. In the category of 0 to 8%, again, the model does better than the index. In the 8 to 15%, you can see that again, most of the times the model is able to do better than the index. However, in the last category of 15% plus return, obviously the model returns are lower than that of the index, but again, there is an 80% upside captured. So, as you can see, during various phases of the market, different durations, the CR-BAF model has been able to deliver 80% upside and 60% downside on an average basis. Coming to the equity and the debt part in terms of active management, the equity part of the portfolio will be approached like any diversified flexi cap strategy that we have in Canara Robeco. So it will be top down in terms of sector selection and bottom up in terms of stock selection. We would be more large cap oriented, so there would be 70% weight towards large cap. Reason being is that we also feel that since BAF as a product also has derivatives in it to meet the gross equity exposure, we would want to keep the portfolio as liquid as possible. So hence the large cap orientation also to that particular extent. Coming on the debt side, so as a fund house on debt, you all know that Canara Robeco is conservative, so we do not take any credit risk. So you will always find AAA rated papers within our portfolio. So we will try to create alpha by taking a call on duration, and that's what we will also do here in the CR-BAF portfolio also. So just to summarize to you all regarding CR-BAF, CR-BAF is a three-factor model comprising of a forward price to earnings, trailing price to book, and the equity risk premium. The CR-BAF model's focus has been on providing a balance between return and risk, better risk-adjusted return to the investors, and also seeing to it that there is an optimum upside participation and managing downside risk that the model is able to deliver at different points in time across different market cycles. We would be maintaining a gross equity exposure of 65% at all points in time so that there are tax benefits to the investors. So, just to conclude, like I said at the start of the presentation, also, it's time to, have a conversation on not only return but also risk adjusted return. Balance Advantage Fund is definitely a good solution to diversify, a good product to diversify your investors' portfolio at this point in time. So, we are coming out with our NFO. It starts from July 12th tomorrow to July 26th. And we look forward to your interest and support, obviously. Thank you. I'm happy to take any questions at this point in time.
Yes, thank you, Annette, so much. I would like to extend a heartfelt thank you to you for sharing invaluable and insightful session and definitely sharing your expertise with all of us. Her extensive experience and deep understanding on the financial market have provided us with the wealth of knowledge. So thank you once again. And yes, again, I'm putting it to everybody's notice that the NFO is going to start from tomorrow and it is going to end on 25th July 2024. So please keep your focus on the same. And now let's move to the Q&A session. I have received few questions from our partners, so which I'm putting on screen. Just a minute. Yeah, is it visible? I'll just read out for everybody's convenience.
Yeah, sure.
So my first question to you is how does the balance advantage differs from the hybrid in terms of risk?
Sure. So, hybrid, as you all know, is very static in terms of its equity allocation. So, largely maintained at 70%, 75% at all points in time. On the other hand, BAF is obviously more of a dynamic product. So, the allocation between equity and debt keeps changing at different points in time. Even in our product, the net equity allocation can either be as low as 30% or can either be as high as 90% at different points in time. So because obviously, it is so dynamic, very wide range. So the risk is obviously managed accordingly. And we have seen, particularly during periods of volatility, as we saw in the presentation, like during GFC crisis or when the markets have been flat over, longer period of time or even shorter duration, BAF as a product is able to do better than hybrid as a product.
Okay, thank you. So I think all our viewers are clearly understanding the difference between balance advantage and hybrid. Thank you. Moving to next question. What criteria will be used to select stocks and bonds for the portfolio?
So the criteria will be completely in line with the investment process and philosophy that we have here at Canara Robeco, where we focus on both growth and quality, as we mentioned earlier. In growth, we tend to focus on both compounders as well as alpha generators or opportunistic growth, if you want to call it like that. Compounders for us are those companies or sectors where we have seen that growth visibility has been very strong across various market cycles. These businesses have been very resilient and they have shown sustainable growth rate over a longer period of time. Whereas opportunistic growth or alpha generators are those sectors or companies which are cyclical in nature, or there are various cases where there has been change in management or change in business strategy, on account of which the operating parameters are going to improve quite significantly over a period of time. So hence the portfolio again will be a combination of focus on growth with both compounders as well as alpha generators within it. But the underlying will be quality of the business and quality of the management. So that will not be compromised at all. So it has to be that balance between growth and quality at all points in time. When it comes to bonds, like I mentioned, that we do not take any credit risk. We are quite conservative to that extent. So you'll largely find AAA rated corporate bonds or G-Secs only in the portfolio.
Yes. Thank you, Janet, for bringing the clarity. So moving to next, what is the fund's investment strategy in terms of asset allocation between equity and debt?
So obviously the asset allocation between equity and debt is decided by the model. So because BAF is more of a model driven strategy. However, we would be keeping the discretion of the fund manager also at different points in time. We'll be limiting it to around plus or minus 10%, uh, depending on how we are reading the market or the market context at that point in time.
Okay, thank you. Thank you for that. the precise answer. Moving to next, what is the expected risk return profile of this fund?
Sure. So, I'll answer this more from, a top-down kind of way. If you look at equity markets, the expectation in terms of obviously earnings growth for the next 2 years are somewhere at around 14 to 15% CAGR. If we assume that, the market valuations remain the same where we are right now, which is at around, say, 20 times 1 year forward. So that means you can expect, say, around 13 to 14% kind of return from the markets over next 2 years plus. As you know, with CR BAF, our endeavor was to capture around, say, 80% on the upside. So at 14 to 15% means somewhere at end of.
Very elaborative answer. Yes. Moving to next, often will the asset allocation be reviewed and adjusted? Yes.
So we would be monitoring the model on a daily basis. So the review will happen daily. However, in terms of adjustment, it would be once in a fortnight. Uh, However, we are also keeping the leeway that depending what is the enhanced fortnight also. Reason being is that we all saw the period of COVID where the market correction was very sharp, and obviously it happened in a very short duration. So even if we would have waited for 15 days during that period, we would have lost out the opportunity to make alpha. So hence, while the review happens daily, the adjustment will happen either on a fortnight basis or sooner than that.
Okay. Thank you. Thank you for bringing the clarity once again. Moving to next, how does this fund aim to perform in different market condition, either bullish, bearish, or volatile markets?
So you obviously saw the back test results for for the BAF for the CAR BAF model, especially during the volatile markets, and we have seen that the model has done really well during these volatile periods, whether the volatility was for a shorter duration or for a longer duration. With respect to bullish and bearish, like I said, that we have tried to see to it that the model in terms of upside captures 80%, and on the downside, it limits it to around 60%. So that's how we expect the model to perform during the bull and the bear phases also. As we have seen that even in a back test, we have also showcased that whenever the returns for the index have been negative, or the index returns have been 0 to 8%, the model in both those buckets than what the index has done.
Surely. Thank you. Next question is, how does this fund fit into investors' overall portfolio strategy?
So when we speak to investors regarding how their portfolio should look, so we say that there should be around, say, three categories as such. One should obviously be your high risk ones, which is small cap, mid cap, thematic. The other should be a lower risk one, which comprises of, say, large cap, flexi cap, diversified kind of strategies. And the last should be a product which is obviously lower in terms of risk, but obviously sees to it that it can still give optimum returns, which is your balanced products like either BAF or aggressive hybrid. So we always say one third, one third, one third of your portfolio, you should be managing your return and your risk expectations accordingly. So definitely BAF as a product should be part of the balance category, so somewhere at around one third of an investor's portfolio.
Yes, thank you. Absolutely. Thank you for the great answers, Annette. And with this, we possibly having this set of questions we have with you. So with this, I think we are ready to conclude today's session. So I would like to just focus on one thing. Thank you, Annette. Your journey from the research associate to fund manager equity is truly inspiring, and we are grateful for the time and effort that you have invested in enlightening us today. Your contribution have undoubtedly enriched our understanding for the equities and equity related markets. So thank you once again, Annette, for the
Thank you.
enlightening presentation from your side. And thank you for being with us. Thank
Thank
you
you.
so
Thank
much.
you, Disha, so much. Thank you for having
Yes.
me and have a good day today. Thank you so much.
Thank you. Thank you, everybody. And thank you, all the participants who have attended the event. Thank you once again. Thank you, all our partners as well. With this, we are concluding this session. Thank you.
Thank you.